You've been paying down your mortgage for years. Your home has gone up in value, and now you're sitting on a gold mine of equity that's just sitting there. What if you could turn that equity into an income-producing property? What if you could use it to fund a flip, buy a rental, or invest in a cash flow deal without selling your home? That's exactly what a HELOC, a home equity line of credit, lets you do. In this guide, I'm going to break down how a HELOC works, how to use it for real estate investing, the risks you need to know about, and real-world examples of turning dead equity into real cash flow. By the end, you'll know exactly whether a HELOC is your shortcut to growing a real estate portfolio or a dangerous debt trap you should avoid. Let's start with the basics. A HELOC is a line of credit secured by your home's equity. Think of it like a credit card, but with your house as the collateral. The bank gives you access to a set amount of money, maybe $50,000, $100,000 or more, based on the value of your home minus what you owe on your mortgage. And you can use that money for just about anything. Renovations, education, emergencies, and yes, real estate investing. The big advantage? You only pay interest on what you actually use, and rates are typically much lower than credit cards or personal loans. So why do real estate investors get so excited about HELOCs? Because they turn equity, which is just a number on paper, into actual buying power. You can tap into your home's value without selling it. You can make offers in cash, close quickly, and compete with other investors. And you can reuse the same HELOC funds over and over. Borrow, invest, pay it down, repeat. It's a revolving line of credit, not a one-time loan. That flexibility is huge for anyone trying to scale their portfolio. Before you can use a HELOC, you need to qualify. Most lenders want you to have at least 15% to 20% equity in your home after the HELOC is in place. They'll look at your credit score, typically 620 or higher, but 700 plus will get you the best rates. They'll also check your debt-to-income ratio to make sure you can handle the payments. The more equity you have and the better your credit, the bigger and cheaper your HELOC will be. All right, here's where it gets exciting. There are three main ways investors use HELOCs. First, as a down payment. You can use HELOC funds to cover the down payment on a rental property, then finance the rest with a traditional mortgage. The rental income ideally covers both the mortgage and the HELOC payment. Second, to buy property outright. If the HELOC is large enough, you can buy a property in cash. That can give you leverage in negotiations and potentially better deals. You can then refinance into a long-term mortgage, pay off the HELOC, and keep the property. Third, for renovations or BRRRR deals. Buy a property with a regular mortgage, use the HELOC to fund the rehab, increase the property's value, then refinance to pay off the HELOC and repeat the process. Let's say your home is worth $400,000 and you owe $250,000 on the mortgage. That's $150,000 in equity. A bank might give you a HELOC for up to 80% combined loan to value. So in this case, $320,000 total debt allowed. You already owe $250,000, so your HELOC limit could be around $70,000. You use $50,000 of that to make a 20% down payment on a $250,000 duplex. The duplex rents for $2,500 a month. Your mortgage and HELOC payment combined are $2,000. That leaves $500 a month cash flow, and the tenants are helping pay off both loans. Now, before you run to the bank, let's talk risk. A HELOC is secured by your home. If you can't make the payments, you could lose your house. HELOC rates are variable. That means your payments can go up if interest rates rise. And if your property investment doesn't cash flow as planned, if repairs pile up, vacancies drag on, you could be stuck paying both your regular mortgage and the HELOC out of your own pocket. The key is making sure the investment produces enough income to more than cover the cost of borrowing. Here's how to protect yourself. Don't max out the HELOC just because you can. Run the numbers conservatively, assume higher interest rates, lower rent, and unexpected expenses. Have a clear exit plan for paying the HELOC down, whether that's from rental income, a refinance, or selling the property. And keep an emergency fund separate from your HELOC. That way, if your investment takes longer to pay off than expected, you're not scrambling. Sometimes the smartest move is not to touch your equity at all if you don't have a strong understanding of the market. If you're buying a property with negative cash flow, or if your personal finances are unstable, high credit card debt, no savings, a HELOC could dig you into a deeper hole instead of building wealth. It's a tool. And like any tool, it can build something great or cause serious damage if used carelessly. One of the most common strategies with a HELOC is the buy, repair, refi model. You buy the property using HELOC funds, rehab it to increase value, then refinance into a long-term fixed mortgage, paying off the HELOC. That frees up the line of credit to use again. Another option is to sell the property after improvements, use the profit to pay off the HELOC, and pocket what's left. The point is, always have a plan for how you'll return that balance to zero. A HELOC can be one of the most powerful tools in a real estate investor's toolkit. It can turn idle equity into cash flow and accelerate your portfolio growth. But it's not free money, it's debt secured by your home. If you use it wisely, it can fast-track your financial freedom. If you use it recklessly, it can put everything you build at risk. Know your numbers, have a plan, and treat that line of credit with respect. If you found this guide helpful, hit the like button and subscribe for more real estate investing strategies. Drop your HELOC questions in the comments, and I'll share my honest thoughts based on deals I've done. And if you want my free HELOC investment calculator to run your own numbers before you borrow, the link is in the description. Until next time, keep learning, keep investing, and keep building wealth.